Well, is it lunch, dinner, something in between? What is it? Dinner?
Something in between.
Okay, we're almost there. Okay, it's time. So welcome back. And now the quiz is over, hopefully you're more relaxed. It's behind you. In corporate finance, we make a big deal about sunk costs. You know what you do about sunk costs? Absolutely nothing. Let it go, move on. And one thing to remember, if you, in case you don't remember from the first session, I said when you do the three quizzes, all three, you get a freebie. One of your worst of your three quizzes, I will replace the score on that quiz with the average on your remaining exams. Now, obviously, the good news for you then is if this is a bad quiz, you can take it out of the system. The bad news is you've used up your freebie. So hopefully this isn't the quiz you want to use up the freebie on, but if you did, it's not the end of the world. But you should be able to check your grades and stuff very soon. I mean, it should be actually set up at midnight tonight. You should be able to check and make sure that you get your grades in. No. But before I get started, I want to kind of wrap up something I kind of hit at the very end of the class last session, which is free cash flow equity. And I want to kind of, and a few people are confused about this notion of free cash flow equity and how it's different from free cash flow firm. The only difference is free cash flow equity is after debt payments, free cash flow firm is before debt payments. That's really it. Right? And when you use free cash flow equity, the discount rate used is the cost of equity. The one thing that's interesting about free cash flow equity is you can pump up your free cash flow equity by using debt. By borrowing money, you have to reinvest less of your own money. You can make your cash flows go up, but it comes to a consequence, which is your equity gets riskier. Your cost of equity will go up as well, which means the net effect can be positive for some companies, negative for others, and neutral for still others. You cannot tell until you've looked at a specific company. So today we're going to leave the safe harbors behind because in a sense, when you talk about earnings and cash flows last year, you pulled out of last year's financials, last year's annual report. When you did cost of capital, we got betas by looking backwards, but discount rates and cash flows, you're still drawing on numbers that are already out there. But when you value a company, there is no way around the fact that your value lies in the future. You got to project growth. So today I want to talk about growth. And I want to start with a very simple statement, a statement that is surprisingly controversial. Growth is not good, it's not bad, it's not neutral. It can be good for some companies, bad for others, and neutral for others. So Kimberly, I'm going to put you on the spot. In what way is good? What's a good side of growth? What happens when you're growing earnings? What's a good side?
Like your value goes up.
Yeah, earnings go up from 100 to 200. That's good, right? You have higher earnings. What's a bad side of growth?
I guess like
How did you get the growth in earnings? What did you have to do to get that growth in earnings?
You had to spend money.
You had to spend money building plant, equipment, R&D, acquisitions, right? So in other words, a good side of growth is I can make my earnings go up. The bad side is I've got to put all this money into the business. And you can already see it's a net effect that drives growth. If I can put relatively little in and get a lot of growth, that's really great, right? That's what Facebook has done. And all the great companies, that's what they pull off. If I put a lot in and get a lot, it might offset each other. Growth can be neutral. Or I can put a huge amount in and get very little to show for it, in which case I'll grow, but I'll destroy value as I grow. So one of the things I want to talk about today is this link between growth and value. And to set that up, I'm going to talk about how we generally go about estimating growth. Okay? Remember, you have a project and a company you pick, it's kind of gone into the background, you've completely forgotten about it. But at some point in time, you have to rethink about it because you got to value the company. And one of the things you need to do to value your company is to estimate future growth. So when you sit down to estimate growth for your company, what's the first thing you're probably going to check out? What's the first thing most of us, so if I say, what's the growth rate going to be for the next 5 years? What's the first thing we generally check out for the company we're trying to value?
Personally, I would look at past growth.
Right? That's the logical place to start, right? Because if you want to project the future, might as well start with the past. It's called historical growth. I want to start with that today, talk a little bit about how it can sometimes be difficult to get a past growth rate. You think about the numbers, why is it so difficult? There's a mathematical challenge you can face, and sometimes why it can be misleading. Why having a high growth rate in the past might not give you a high growth rate in the future. So I'm going to start with historical growth. But let's face it, for many of you, this is the first company you value, right? Fully. So you feel a little lost. You're saying, I really don't know much about valuation. I don't know much about my company. I wish somebody would tell me what growth rate to use. And you know what? You live in a world where looking up what so-called experts think about the growth of your company is trivial. Today, we're going to talk about equity research analysts. Equity research analysts work for Goldman Sachs, Morgan Stanley. They track your companies. They spend their entire lives following these companies. They must know more than you and I do, right? And they actually estimate a growth rate for the next 5 years. And some of you are going to be tempted to say, well, if that growth rate is out there, why would I go to the trouble of doing my own? Because they've done it for me. They know more than I do. So I want to talk about analyst estimates of growth. And if you work for an appraisal company, appraising companies, you know how most appraisers get growth rates for their companies? So a company hires you to appraise their value. You know how most appraisers get the growth rate? They ask the managers, what do you think the growth rate will be? Again, the implicit view is they must know more about the company than I do. So I'll ask the CEO, what's your growth rate going to be? So let's call that second grouping outsourcing growth. Analysts, managers. We'll talk about the limitations and dangers of doing it and why building your entire valuation around somebody else's views on growth can be so dangerous. Historical growth, other people's estimates of growth. And I'm going to push you towards a third way of thinking about growth, which I think is the healthiest way. Growth has to be earned. You and I can't go around giving companies high growth rates just because we like them or because we feel like it. To grow, companies have to do two things. One is they have to put money back into their businesses, whether it's in land, building equipment, or R&D, depends on the business. They have to put money back. And they have to put whatever money back there into profits. They have to earn. So the two questions you need to answer to address, will my company grow in the future and create value, is how much is it reinvesting? How well is it reinvesting? It's called intrinsic growth. So let's start with historical growth. Historical growth seems like a fact, right? So if I ask you, what's your growth in earnings per share or growth over the last 5 years, you'd think we'd all agree on a number. So if I gave you Coca-Cola and said, what's the growth rate over the 5 years? If I gave this class the assignment, what's the growth over the last 5 years? I'll wager they would come back with about 25 different numbers. You think, why? First, it depends on how you compute your average growth rate. You can compute a simple average where you take 5 years of growth rates, average them out, just add them up and divide by 5, or you can compute a compounded growth rate. You can compute growth in revenues, growth in EBITDA, growth in EBIT, growth. I can tell you growth in what, so you can come up with different growth rates. You can even play with starting and ending periods. 2014 is your starting period. You can get a different growth rate than 2015. And even if you get that growth rate, there are two issues that can get in your way. One is if your company goes from having negative earnings to positive earnings. It's actually very difficult, almost impossible to get a growth rate for that year, and I'll show you why. And also, if you have a small company that's become a big company. Take Netflix. It's a company that's, if you look at its size, has quadrupled its revenues over the last 5 years. For the last decade. When you have that much growth, you've gone from a small company to a big company, knowing the past growth rate can actually be dangerous because if you apply that growth rate onto the future, you might overestimate growth because as companies scale up, as they get bigger, it gets more difficult to maintain percentage growth rate. Just a pure math issue. It's one thing to double your earnings when you have $1 in earnings. Try doing that when you have $1 billion in earnings. So let's start with some very simple mechanics on historical growth. About 20 years ago, I wrote the first edition of one of my books, The Dark Side of Valuation. And one of the companies I looked at was Motorola. So this is set way back in time. Don't worry about what it tells you about Motorola today because it doesn't even apply. I want to focus on growth rates. So in this table, here's what I've done. I've taken 5 years of numbers on revenues, EBITDA, and EBIT. Actually, 6 years of numbers on each of these. And then I've computed growth rates using different choices. Let's start with revenues. I computed the growth rate every year. So growth rate in year 1, year 2, year 3. So I've got 5 years of growth rates. If I take a simple average of those 5 numbers, just add them up and divide by 5, I come up with 7.08%. But if I take a compounded average, where I look at the starting number and the ending number, I come up with 6.82%. You think, big deal, that's pretty close. They round up to 7%. You're absolutely right. With revenue growth, I get pretty close numbers. When I try the same thing with EBITDA, my arithmetic average growth rate is 10.89%, but my geometric average is 5. Notice the difference has become much wider. And when I go to EBIT, it becomes even wider, 40% plus versus 4%. So Morris, I'm going to put you on the spot and ask you the question, why is my difference between arithmetic average and geometric average growth rates changing as I go from, clearly it's least with revenues, becomes larger with EBITDA, becomes even larger with EBIT. What is it about revenues that gives it a smaller difference in those growth rates than EBIT? What's happening?
Sorry, can you say that again?
If you look at the difference between the arithmetic average growth rate and the geometric average, the difference is very small with revenues, much bigger with EBITDA, even bigger with EBIT. What's causing the difference to widen, you think? You can pass if you don't feel comfortable answering.
Yeah.
So,
Yeah, I think I'm going to pass.
Parker, I'm going to put you on the spot, but I'll help you out here. I'll ask you a limiting question. What has to be true for those two numbers to be the same, the arithmetic and the geometric average? What has to be true about growth rates every year that'll give you the same arithmetic and geometric averages?
There would have to be consistent growth.
It has to be exactly the same growth rate every year. If I have 8% growth in year 1, 8% in year 2, 8% in year 3, 8% in year 4, 8% in year 5, my arithmetic average is 8, my geometric average is 8, right? The greater the volatility in growth rates, the bigger the difference. So take a look at the standard deviations. Revenue has the least volatility, that's the smallest difference. EBITDA has more volatility, bigger difference. EBIT is even larger. If I gave you net income and earnings per share, guess what you're going to see? Even larger, because the further you go down the income statement, the more volatility there's going to be in the numbers because you have more stuff to deal with. You know what that tells you, right? If you're talking about revenue growth and you give me an average growth rate, I might not follow up and ask whether it's an arithmetic or a geometric average because the numbers might be close. But if you give me earnings per share growth and you say the growth rate, the average growth rate over the last 5 years is 11%, my due diligence requires me to ask you, was that an arithmetic average or a geometric average? And I'm not nitpicking because the geometric average might be 2%. And so when you hear people talk about the past growth rate in this company is, don't let them get away with it. That's incredibly sloppy. Ask them in what metric. Is it revenues, EBITDA, EBIT, net income, or earnings per share? And follow up by saying, no, how do you compute your average? They think you're a nitpicker. They will hate you. But the reality is the numbers can vary incredibly based on those judgment calls you make. Now let's deal with the other two loose ends. But 25 years ago, I was valuing Time Warner. And one of the things I was interested in what the growth rate in earnings was. And so it was in 1997. They just reported an earnings per share of 25 cents. That is 1997. In 1996, they reported an earnings per share of minus 5 cents. So Jessica Menek, I'm going to ask you a question. They've gone from minus 5 cents in 96 to plus 25 cents in 97. First question is a very simple qualitative question. Are they moving in the right direction?
Yeah.
Absolutely. It's a good year, right? You went from minus to positive. Now comes the mechanical question. If I asked you to compute the growth rate in 1997 in earnings per share, how do we compute growth rates? What do we usually do?
It's growth from the beginning year minus growth from.
So it should be 30 cents. So basically, it went from -5 to +25 divided by what?
The original year or the first year.
Which is -5 cents, right? So if
Mhm.
I take 30 cents and divide by -5, guess what I get? I get -600%. If I told you the growth rate is -600%, that sounds like a horrifically bad year, right? When you go from minus to positive, the growth rates become these crazy numbers, not because the equation is wrong, but because you're going from a negative to a positive. Services face this issue all the time, and they cheat. Here are some of the cheating devices they use. One is, the problem here is not in the numerator, it's the denominator, right? It's negative. So what they do is they cheat and use the higher of the two numbers. So instead of dividing by -5, which is what you're supposed to do, they divide by +25. They get 120% growth rate. The second is they say, hey, the problem is a minus sign. Why don't I just take it out? They call it an absolute value and say, hey, that's +600%. Are you happier now? I've even seen them use statistical regression models to make it look fancy, but here's the bottom line. When you go from negative to positive, and you ask me, what's the growth rate in that year? If I were honest, you know what my answer is going to be? It's not meaningful. I cannot really compute a growth rate. Services can't say that. They got to make up crap and then try to cover it up. But the reality is when you go from negative to positive, you can't compute a growth rate. Doesn't mean you can't do other years, but that particular year you got to take out of the equation. Which brings me to a final problem with historical growth. Jonathan?
Professor, I had a quick question about historical growth versus examining the financial statements.
Yeah.
When you look at financial statements, isn't that just another way of looking at historical growth? Yeah,
because in each item you could look at growth, right? Financial statements are just a big mess, right? So look at financial statements. You got revenues, you got operating income, you got EBIT. So when you talk about growth, you can't talk about growth in statements. It's got to be growth in a metric. It's got to be revenues. Yeah.
I was just unsure how that would count as a third method of looking at growth from that previous slide earlier.
Well, I'm not using financial statements to get the growth. I might get ratios from financial statements, but I've got to make judgments about the future. I'm not stuck using last year's financials to make those judgments. So when I compute a return on equity based on last year's numbers, there's nothing in valuation that requires me to continue to use that return on equity next year or the year after. So when you talk about intrinsic or fundamental growth, that's where your judgment comes in. Because if you locked everything in to what the numbers were last year, you don't need any people to do valuation, right? Everything can be mechanized. It'll give you terrible valuations because you're building off last year's financials. So the fact that you extract numbers from financials doesn't mean that you just have to use them as the numbers going forward, whether it's reinvestment rate or return on equity, return on capital. So it's a starting point for raw data, but it's not our ending point for estimation.
Got it. Thank you.
Okay. Joe?
So in the case that we see in slide 166, we see that the difference between the geometric average and the current or most recent year are very different. One's the one we were.
So you're talking about this. You're talking about the Callaway golf. Can I? Because I haven't talked about it yet. Can I talk about what's happening? Because I'll put you back on. Because with Callaway golf, there's a reason. It's actually a very simple, common sense reason why things are changing. But I think the point you're making is a very good one about forecasting for the future. Should I focus on the growth rates across time, which are going from 255% to 25%, or should I focus on the most recent year? But that's part of a broader question of what happens to companies as they get bigger. What does it do to growth rates? Nick?
Okay.
Yeah, my question is, to solve this problem of the variance between 0 and positive, couldn't you just use this the continuous harmonic average to calculate the
You
The
can do
integral of the
all
third?
kinds of tricks we can do to make the number look more meaningful. My point is, remember, this number is not the number that matters. It's whether you can use it for forecasting the future. No matter what trick I use, whether I use the absolute value or the higher of the two values, the bottom line is the number that comes out of it is almost useless for me in terms of forecasting earnings per share for Time
see.
Warner. So rather than get caught up in let's try a different, just say, look, I can look at past growth that doesn't tell me much about future growth here. So I'm on my own. I have to use something else. So now let's talk about the scaling effect. You've heard of Callaway Golf? Kimberly, you're nodding your head. So what's Callaway's most famous product? Do you know?
Oh, I've heard of it. Is it golf sticks or golf balls?
Golf club. They don't call it golf sticks. Don't tell a golfer that you're calling it golf. It's golf clubs. And it's actually one particular golf club. Nick, what's the golf club that Callaway Golf is known for? What did they create that made them zoom as a company? I can't hear you, Nick.
I'm not sure, honestly.
So it's a golf club called the Big Bertha. So this was in the early 90s. They come up with this new golf club, and golfers are always blaming their equipment for why they're shooting 150 on the shot. So they're always looking, it's a ball, it's a club, it's a course. So this Big Bertha comes out, and it's a huge hit right away. And to show you how much of a hit, look at what happened to Callaway Golf's net profit as they went from 1990, where they were a tiny company, 1.8 million net income, to 1996, 122 million. The compounded annual growth rate, geometric average, is 102%. So this isn't even playing games with arithmetic averages. This is a geometric average. It's true, as Joe pointed out, that the number is coming down, but the geometric average is 102%. There are a lot of people who almost mechanically use geometric averages for forecasted growth. Let's say I'm one of those people. I take the 102% growth rate, hang in there with me. It's a crazy thing to do. And I apply it on the net income for the next 5 years. I take 122 million, grow at 102% a year. Kumail, I want you to guess. If I grow 122 million at 102% a year for the next 5 years, how much, just give me a rough sense of how much do you think my net income will be 5 years from now? Just give me a number that comes out.
Like around $2,000, 1,500.
2 billion or 2
Yeah,
billion?
yeah. 2 billion, yeah.
It actually was $4 billion. And already you can see the danger of putting high growth rate. You know what Callaway Golf would have to do to get 4 billion net income? Every golfer in the world would have to buy a Big Bertha. And even people who are not golfers will have to buy the club maybe as a weapon or something. This is impossible net income. But that's what happens when you apply past growth rates. Now, Joe had asked, why did the growth rate decrease? The reason is very simple. When Callaway Golf started in 1992, it was 1.8 million net income. Increasing that from 1.8 to 6 million is not a big deal. All you have to do is sell 3,000 more golf clubs. By the time you get to 1996, there are 122 million. Not huge, but it's a much bigger number. You can see the growth rate start to decrease as you get larger. It's a common sense perspective, but it's amazing how often people forget that when they're forecasting growth. Let's take Airbnb. Airbnb had about 15, 20 billion in gross billings last year. Let's say it was 20 billion in gross billings. They'd been growing at about 40% a year, right? So let's say you sit down to value Airbnb, use a 40% growth rate for next year. 20 billion will become 28 billion. Can they do it? Yeah, I think they can pull it off. Then you get to year two, you put another 40%. So now they have to go from 28 to 38.6, 10.6 billion. Each year you do this, do you see what you're doing to your company? You're making it bigger. And if you apply common sense, then what should happen to your growth rates as you go through time? Even if you think your company is going to be a great company, the growth rate should start to decrease. So if you look at my valuation spreadsheet, I have a 10-year window. I ask you for the growth rate for the next 5 years, and I'll let you be as optimistic as you want to be about those growth rates. But then after year 5, guess what I start doing? I start moving that growth rate down, not because I don't like your company. I'm trying to get in your way of your story. I'm saying your company is getting really big. that 50% growth rate you assume for the first 5 years has to start coming down. Scaling up is hard to do. Isn't that a song? No, that's breaking up is hard to do. But maybe we need somebody singing a song. Scaling up is hard to do, and blast it out, because it's so easy with small companies to forget that as you let things compound over time. So I know we start with past growth. Amos actually absolutely right. When you sit down to value a company, we look at past financials, past growth. But there's one final thing about past growth I want to tell you, because I think it's a cautionary note. When we use past growth to forecast future growth, what are we assuming? We're assuming that companies with high past growth are more likely to have high future growth, right? Is that a good assumption? Well, that's an empirical question. It's not a theoretical question. So the question is this true in practice? So rather than answer the question directly, I'm going to tell you an anecdote. This is about a guy who came over from the UK to do a PhD at American University. I forget which one. His name was IMD, I.M.D Little. His last name was Little, first name was Little, some name was Little. So he, as his PhD thesis, this is what he picks. He decides to test out this proposition. Is past growth a good predictor of future growth? It's actually a very easy test to run, right? Because you take the growth rate from 1951 through 55, and you take the growth rate from 56 through 60 for every company, and you do a correlation. If past growth is a good predictor of future growth, what should you see? You should see a big positive correlation, right? Might not be 1, but you want 0.7, 0.8, 0.85. I won't tell you exactly what correlation he found, but I'll tell you the title of his PhD thesis, and you can guess what kind of correlation he found. The title of his thesis was Higgledy-Piggledy Growth. Sophie, Higgledy-Piggledy is like a nursery rhyme from the UK, I guess. When he said Higgledy-Piggledy Growth, what kind of correlation do you think he found between past and future growth?
Not really any.
Exactly, higgledy-piggledy. He looked and he said, I can't find any. He found a correlation of close to 0. That is an incredibly scary thought. Remember how much time he spent poring over the last 10 years of financials, and what he discovered is companies with past growth that's good. There's nothing that tells me about future growth. So much as you're inclined to think about past growth, look at it, but then let it go. It's good to know, but it shouldn't be the driver of what you do in the future. Which brings me to the second way you get growth. You guys know how equity research is structured. There's sell-side equity research and buy-side equity research. Sell-side equity research analysts work for the investment banks, and they're the ones you see on CNBC. They talk about buy and sell recommendations. Buy-side equity research analysts work for mutual funds, Fidelity, State Street, and their research goes to the managers with them, so you never hear of it. Sell-side equity research is structured in such a way that if I hired Mohammed as my sell-side equity research analyst, I give him a sector to follow. For instance, I'll say, your sector is entertainment software, and you will track these 15 entertainment software companies. And for the rest of your life, Mohammed, that's all you do. It's a depressing thought, but you track these 15 companies day in, day out for the rest of your life. That's good, right? You're immersing yourself in these 15 companies. Now, your job is to put buy and sell recommendations for these companies to clients. And the way you make these buy and sell recommendations, you think is with valuation, but that's not what equity research analysts spend the bulk of their time on. They spend the bulk of their time forecasting earnings per share. It's a big fixation with analysts as to what the next quarter's earnings per share is and what the next year's earnings per share is. So let's bring those together. Equity research analysts are concentrated on these 15 companies. So Mohammed tracks these 15 companies all the time, and he spends his entire time forecasting growth and earnings for these companies. He must be pretty good at this, right? So when you sit down to value this company, why would you want to ever estimate growth when Mohammed has done it for you? And he spends 9 hours every day tracking these companies, and he talks to the management. So let's start with a question. We spend millions of dollars on sell-side equity research analysts They all spend their time forecasting earnings growth. They must be really good, right? So I'm going to start with the results of studies that have looked at how good they are. And here's how these studies do it. They look at the forecast analysts make and compare them to the actual earnings. Remember, the more precise your forecast, the smaller the mistake you're going to make. They look at the error analysts make. And then they compare that to the error that they made if you just use past data and just forecast, or in other words, with no analysts. So let's take the first study. The first study found that if you use analyst forecast, the error you made in your forecast was 31.7%. If you just use past data, you'd have made 34.1%. You're saving about 2.4%. And for this, you're spending tens of millions of dollars in equity research. That doesn't look like much of a saving to me. It's not like equity research forecasts are close to zero. They're mildly better than past data forecasts. And that's with 1 quarter ahead earnings per share. Equity research analysts also make 5-year growth rate forecasts. And those are almost completely useless. They're no better than just taking past growth and putting it into the future. So about 10 years ago, I was asked to give a talk to SellSide equity research analysts, and I wanted to pick a topic where they would never invite me back again. So I said, okay, you know what? I should talk about how bad their forecasts are. So I went in and I said, look, guys, you spend all your time forecasting earnings. But collectively, why do you guys do such a horrifically bad job? And of course, they found somebody else to blame. They said, no, that's all analysts. But there are a lot of bad analysts here pulling us down. If you chose the very best analysts, and presumably they all live in New York and they all work at the investment banks, they do a much better job than this average you're pointing to. I said, you have a point? So I'll focus on just the very best analysts. In the case of sell-side equity research, I didn't have to do much digging to find out who those best analysts were. Every year, Institutional Investor, which is this magazine that's been around a long time, tracking institutional investment, picks an All-America team. You know how they pick All-America football teams or each position? They have an All-America analyst team where they take different sectors and they pick an analyst in the sector that they tab as the All-America analyst tracking. So Mohammed is going to become the All-America analyst for entertainment software. You have now reached the pinnacle of your profession. From this day on, this is now going to get attached to your name. So you will never introduce yourself as Mohammed. You say, I'm All-America Analyst Mohammed. Your Twitter handle will become All-America Analyst Mohammed. All-America Analyst becomes part of your existence because you've been tabbed the best. So these guys must be really good, right, to get to the very top. So let's see how good their forecasts are. So the study looked at All-America analysts to see, are they better at forecasting earnings than the average analyst? They must be, right? They're the very best. And it found something very strange. It found in the year before they became All-America analysts, they were actually slightly worse than the average analyst in forecasting earnings. But the year after they were picked, they got slightly better. Jacob, what do you think is going on? I mean, you go from, so first, whether you become an All-America analyst seems to have nothing to do with how good you're at forecasting. What does it have to do, you think? It's people vote for it. So if you're a high-profile analyst saying even stupid things, but you're on CNBC all the time, people recognize your name more. So maybe it's got to do more with profile than anything else. But something magical seems to happen here, right? Before you got this tab of All-America Analysts, you were a below average forecaster. After you get it, you become above average. Kumal, you want to try? What do you think is going on? Why do you think I've become a better forecaster?
I just have a quick question.
Go ahead.
Isn't there also an argument to be made that a lot of companies will like manage their earnings specifically based on forecasting, like go lower than
That's
that?
fine. So let's suppose companies manage their earnings. You can use time series to forecast earnings. You use analysts. So no matter what the structure is, analysts should bring something to the table, right? So if they manage earnings, presumably these analysts have been tracking these companies for a long time. They've seen how they manage earnings. They should do a better job than a time series. So no matter what setup you have for why earnings are what they are, if you're an analyst and you spend all this time and all the resources and all the connections, your forecast with whatever structure should be better than a pure time series forecast. So I'm not disagreeing with you on earnings management and how it plays out, but I'm saying no matter what you assume about the rest of the world, analyst forecast should bring in more information, should therefore be more precise. Why is it not happening? Nick, you want to try on the All-America analyst? What do you think happens that makes them better forecasters?
Yeah, like I think you said like in the beginning of your lectures, like you become a catalyst, and amongst all the retail investors and institutional investors, which makes the market move towards your numbers.
Okay, Mohammed, you're the entertainment analyst, and I'm one of your companies. Take Two. Last year when you called me, I'm the CFO. So you called me hoping to get some dirt you could use in your research. And I said, who are you again? He said, I'm Mohammed Danal, I work for. I said, I never heard of you. I hang up the phone. Now you've been tagged All-America Analyst. You call me again. You say, this is All-America Analyst. Remember to use that always as part of your introduction. This is All-America Analyst Mohammed. You know what? I'm not hanging up the phone on you. I might give you information you did not. So your access improves magically because you're now the All-America Analyst. And now when you make recommendations, when the Wall Street Journal reports in your recommendation, you know how they're going to report it? All-America Analyst Mohammed, I'm serious. This now becomes part of your entire existence. All-America Analyst Mohammed and I'll just put out a sell recommendation on the company. And you know what? Magically, your effect on markets also seems to improve. What does this mean? It basically means when you're valuing a company, if there's All-America Analyst, the growth rate might be slightly better, but that's not going to be magically better. But it shows you how much of this is, it's basically, shadows where perception is driving the reaction. And even when you affect the price, the effect is often temporary. If you put a buy recommendation. But if you put a sell recommendation, there seems to be a much larger impact. That's very strange. Sell recommendations, the stock price drops and it doesn't fully come back. Buy recommendations, stock price goes up, but you give up most of the gains in the next few months. Why do you think that is? Why are sell recommendations so much more, that leave so much more effect than buy recommendations, you think? Do you remember what I said in I think the first class about how many recommendations will buy versus sell? You remember the ratio? It's like 9-1. 9 buy rec. So when you see a sell recommendation, it's so unusual, it wakes people up and say, Mohammed must know something terrible about the company to put out a sell recommendation. It has much more impact. Sriram?
I was gonna say something similar, but I guess in terms of incentive structures, like how do you ensure that, like, I guess if people are to trust equity research, how do they look past the incentive structure there?
Actually, you've raised a good question because you've led into something I've thought about for a long time. I'll be quite honest. One of my regrets of teaching valuation so long is too many of my students have become sell-side equity research analysts. Too many. I try to talk them out of it, but I'd say I would count at least 200 students of mine or sell-side equity research analysts. I think at least 6 head equity research departments at different investment banks. And so I worry about the future of sell-side equity research. So I've thought about what is it that's causing sell-side equity research to implode? Because the reality is it's lost its way. I mean, you pick up a sell-side equity, you read it for laughs now. You don't read it for information. You don't read it for recommendations. It's kind of a comedy show. So let's think about what it is about the way sell-side equity research, because these are bright people. I knew them when they were in my class. They knew how to do intrinsic valuation. They're very bright people. So it's not the people, it's the process and the system. So let's think about what it is about sell-side equity research that makes it so flawed. First, when I picked Mohammed as a sell-side equity research analyst, what did I do? I gave him a sector, right? Entertainment software. I gave him 15 companies and I said, just worry about these 15 companies. Don't worry about the rest of the world. And for the rest of your life, you focus on these 15, you forget the rest of the world even exists. First problem with sell-side equity research is its tunnel vision. It puts you into these really narrow sectors, and before you know it, you're so focused in that sector, you forget about the rest of the world. Second, if Mohammed is one of 25 entertainment software analysts, he's going to spend a lot of time watching the other 24. You know why? Because you never want to be left alone in one direction. So let's say everybody's neutral, all 25 are neutral in a company, and 3 put out buy recommendations. And then 5 put out buy recommendations. You know what? You're saying, maybe I should put out a buy recommendation too. There's a lot of lemmingitis in this process. When you see buy recommendations, you see everybody rushing to buy. When you see sell, everybody pushes towards sell. The third is a variation of what I call the Stockholm syndrome. You heard of the Stockholm syndrome? Became famous in the 1970s. It was chronicled in the 1970s. And Stockholm syndrome refers to the fact that when people are taken hostage, after a while they start identifying with the hostage takers rather than with the people trying to rescue them. Must have happened in Stockholm. I guess that's why they call it the Stockholm syndrome. You say, what's this got to do with sell-side equity research? When you think sell-side equity research analyst, you think of somebody who's asking tough questions, looking at companies' weaknesses, making a judgment that you would like to be this honest, fair judgment of the company. That's what you're next. And maybe that's how many sell-side equity research analysts start, but after a while, they seem to get co-opted. And they seem to think their job is to defend the company rather than to look at the company. You can see why, right? It happens, right? You follow 15 companies for 40 years. You get to know the managers. You start to get to know, these people are your friends. You've become part of the system. You're not going to step back and say brick and mortar retail is not working anymore in all 15 companies and brick and mortar retail companies. You're going to look at a company like Amazon and say, hey, that'll never, who buys stuff online? That is crazy. The fourth thing that happens, and I've noticed with sell-side equity research reports, especially as you can make these bigger and bigger documents and create better and better graphs, they're beautifully produced. There are pictures, there are stories. And sometimes I have to look through 50 pages to find a number. You're doing sell-side equity research. You're not Charles Dickens. Don't paint character portraits. Start talking about numbers at some point in time. And there's a final issue. Mohammed, I'm going to make you a Goldman Sachs equity research analyst. That sounds like a pretty fancy place to work. And you have Take-Two as one of the companies you cover. But coincidentally, Goldman Sachs is also the banker for Take-Two. They can raise the capital. They took a Take-Two public. Now I know there are Chinese walls in banks, but I also know there are holes in these walls and people climb over the walls and under the walls and do all kinds of crazy things. Supposedly, you're supposed to be insulated from the investment banking division. But I guarantee you, if you put a sell recommendation on Take-Two, you're going to get a phone call from a person you don't want to get a phone call from saying, what the heck did you just do? We've got this big deal coming up with them next month, and you put a sell recommendation on it. I call this the Dr. Jekyll, Mr. Hyde problem, which is you don't know what hat you're wearing. Are you an equity research analyst? Or are you working for the investment banking arm? So Sriram, the long answer to your question is to fix sell-side equity research, we've got to change the structure. We've got to separate it from investment banking. You cannot be a serious sell-side equity research analyst with an investment banking arm. We have to make analysts who can move across sectors. It's crazy to give people 15 companies and say, this is all you can care about. They have to be aware of what's going on in the rest of the market. We have to defend analysts when they put out sell recommendation. By we, I mean the entity that hires these sells has to stand behind the analyst. You'd be amazed at how quickly analysts are left out to dry when the company comes after them. The investment bank says, no, that's you're on your own. And maybe if we do this and we focus on giving these analysts more independence, they can go back to doing what they were meant to do, which is to ask key questions about companies and provide information. So here's the bottom line on equity research analysts. Right? So when you're valuing a company, you'll be able to find an analyst growth rate for your company. It's easy. You can find it on Yahoo Finance. You can find it on Capital IQ. You can find it on any number of sources. I'll give you ways to get to it. And that growth rate might be very different than what you're planning to use for your company. And part of you is going to say, I must be wrong. They must be right. They're the analysts after all. I think there's far less information in those analyst growth rates than you think. Second, remember the biggest source of information that analysts have is the company itself. You think, so what? The company is a biased source of information. And the SEC has become much more stringent about the kind of information companies can reveal analysts. So there's not that much private information. So I'm not saying don't look up what analysts are forecasting as growth for your company, but I'm saying don't make that your growth rate as well, because it's not going to be your valuation then. You've turned over the most critical number in your valuation to somebody who's not that good at forecasting growth. So historical growth, look at it, let it go. Analyst growth, look at it, don't get too worried if it's different from what you're planning to use. Which brings me full circle back to fundamentals. Let me start with a very simple abstract example. Let's suppose you have a company with $1 billion in invested capital. So it's already invested $1 billion. It's making a 12% return. So right now, its net income is $120 million. $1 billion times 12%. This company is adding new investments of $100 billion. So that's new investments it's taking. It's expecting to make a 12% return on that new investment as well. The math then works out, right? If I ask you what's the earnings going to be next year, it's going to be the 120 you did before, but $100 in additional investment times 12% gives you an extra 12 million. So your income goes from 120 million to 132 million. I know it's incredibly simplistic, but where did the change come from? Why did income go up by 12 million? Because you invested 100 million in new projects and made a 12% return on that new investment. In fact, if I were to state it as a growth rate, here's what it's going to look like. The 12 million is a 10% growth rate over the 120 million. And that 10% growth rate came from the fact that you put 100 million back into the business. That's a reinvestment you made. That's 83% of your income. And you earned a 12% return on that investment. This is called a sustainable growth equation. Your reinvestment rate times return will give you the growth rate. But it works only if your return on equity stays stable. You're saying, what does that even mean? Go back to the original example. You had $1 billion invested, earning 12%, right? Let's assume that you don't plan to reinvest any money, but that you think you can increase your return on equity from 12% to 15% by cutting costs, being more efficient. Will your income grow next year if you increase your return on equity from 12 to 15%? Yeah, 12% of $1 billion is 120, 15% of $1 billion is 150. Your income is going to go from 120 to 150. Why? Because you are more efficient in the way you ran the business. If you cut it down to basics, there are only two ways you can grow. One is to invest in new assets and earn a return on that asset. Think of that as reinvestment-driven growth. The other is to be more efficient with existing assets and eke out higher margins and higher returns on that. So reinvestment growth and efficiency growth put together is the growth in your company. The one problem with efficiency growth is it's finite. You know what I mean by finite? Next year you get more efficient, the year after you get, there's some point at which you're going to be so super efficient you've hit a wall. So if you're talking about long-term growth, it has to come from reinvestment. If you're talking about short-term growth, it can come from both places. So one of the things I'm going to start with now is a discussion of what's called sustainable growth. Many people see these equations and think they're magical, but they're not. I'll talk about the assumptions that drive it and when it makes most sense to use them. In sustainable growth, you ask two questions. How much am I reinvesting? How well am I reinvesting? And how you answer the questions will depend on whether you're focusing on earnings per share, net income, or operating income. So you've gone from two equity measures of earnings to an operating income measure. Tony?
Oh, sorry, that was from before.
Okay. So let's talk about how you answer the two questions. So how much are you reinvesting? How well are you reinvesting? If I'm focusing on earnings per share, I'm going to measure how much you're reinvesting with what's called a retention ratio. You say, what's a retention ratio? You know what a payout ratio is? Does anybody know what a payout ratio is? Come on, you've heard of payout ratios. Louis Meeks, what's a payout ratio?
The payout ratio is it's like how much of the net income the firm pays to stockholders?
As dividends, right? So if I have 100 million net income and I pay out 60 as dividends, I have a payout ratio of 60%. You know what the retention ratio is? Whatever's not paid out. So if my payout ratio is 60%, my retention ratio is going to be 40%. If my payout ratio is 20%, my retention ratio is 80%. So when I ask you how much you're reinvesting, you just tell me, well, I'm putting back 80% of my net income. That's my retention ratio. Now that money presumably is going back into the firm and it's being reinvested. What are you earning on that reinvestment? Remember, you focus on equity reinvestment. So you look at the return in equity you make on that. So how much you're reinvesting becomes the retention ratio. How well are you reinvesting becomes the return on equity. That's if you're looking at earnings per share. If you're looking at net income, overall net income, answering the question how much are you reinvesting gets a little trickier. And here's why. When you're looking at just per share earnings, you're kind of stuck. You can't reinvest more than your net income. You're stuck, right? That's the limit. But if you're allowed to raise new shares, raise new equity, you could reinvest a lot more than your net income. In fact, when you talk about growth in net income, you have to look at not just what the company is putting back, but what it's actually reinvesting. It's called the equity reinvestment rate. It's a fancy way of saying, you tell me what the net income is, and then tell me how much you're putting back in the businesses, net capex and change in working capital. Equity reinvestment rates measure what's being put back in the business. It's a much broader measure than retention ratios. And when I ask you, what kind of return are you making on that investment? Remember, this is equity being invested in your operating assets, in your movie business, your theme parks. I'm going to measure your return on equity by looking at what income you make from your non-cash assets, right? Your operating assets, and how much you've invested in equity in those assets. So it's called a non-cash return equity. It's still a return equity because it's an equity measure. So notice a subtle shift from retention ratios to equity reinvestment rates, from return equity to non-cash return equity. If you ask me, what's my operating income going to grow at? I'm going to become even broader. There, I measure reinvestment by how much of my after-tax operating income, not net income, but after-tax operating income gets put back in the business as net capex and change in working capital. So all that studying you did for free cash for the firm, that net capex and change in working capital. And when I ask you, how well are you reinvesting? I look at returns on overall capital, not just on equity, but on debt plus equity. It's return on invested capital. Now, I want to say something about return equity and return capital, and then I'll deal with the questions. This is the only place in finance, only place where we use book values. Think of all the numbers we've used so far. Debt to equity and a levered beta, market value. Debt and capital and equity ratios and cost of capital, market value. When you do return on equity and return on invested capital, it's the only place in finance where we use book values. And the reason we do it is we want to see what's actually invested in existing projects, and we're hoping and praying book value measures that. But because it's book value based, it comes with a load of poison, right? Because there are accounting numbers, and everything accountants can do to affect those numbers will affect your accounting returns as well. But we'll come back and talk about those corrections. But somebody had a question. I'm sorry, I kind of interrupted.
Yeah, Professor. So I'm just wondering why, when calculating equity reinvestment rate, you subtract out the change in that.
Because you're looking at only the money you invest as an equity investor, right? That's the focus in equity is, let's suppose you have a reinvestment of 100 and 30 of it comes from debt. All you have to reinvest is the remaining 70. So it's the same rationale when we did free cash flow equity that we took out the debt effect. We're saying some of this reinvestment is being paid for debt. It's the remaining amount that has to come from equity. In fact, that's the big difference between reinvestment rate and equity reinvestment rate, right? Equity reinvestment rate, I look at the total reinvestment. I'm sorry, the regular reinvestment rate, I look at the total reinvestment, but the equity reinvestment rate, I net out how much of it I can get from debt.
You are not calculating from cash flow, right? You just use the net capex plus the change in non-cash working capital. So why does that too needs to just subtract the change in that?
Because when you borrow money, you need to reinvest less of your own, right? Just think in common sense terms. This is the question you're asking is, I am the equity investor in this company. How much do I need to come up with to allow for growth? The more you borrow, the less you have to come up with. It's not that you're reinvesting less, but your portion of the reinvestment becomes smaller because you're letting lenders carry a bigger weight. So let's try this with growth and earnings per share. Growth and earnings per share, I said, is a product of retention ratios and return equity. Now, retention ratios, what's the highest retention ratio you can have as a company? Angela? What's the highest retention ratio a company can have? 100%, right? You can't reinvest more than a retention ratio cannot exceed 100%. So if that is true, then your growth in the long term in earnings per share cannot exceed your return equity. So if you're a company with an 8% return equity and you ask me, can I grow earnings per share 25% a year in the long term? My answer is not in this lifetime. Because an 8% return equity, the highest long-term growth you can get in earnings is 8%. You're saying, but I'd like to grow at 25%. Well, pigs wish they have wings. You can't get things you cannot get. So if your return equity is that bad, you can't grow at 25%. So let's try this on a company. Okay? You heard of Wells Fargo, right? So I'm going to show you a growth rate estimate I made in 2008. Tim, I'll come back to you. Okay, go ahead, Tim. What's your question?
No,
I can't hear. Yeah,
I'll ask later.
Okay, so let's take Wells Fargo. This is June of 2008, before the 2008 crisis. I was valuing Wells Fargo, so I followed the rubric. I computed return equity for Wells Fargo, 17.56%. Why was it so high? Banks were doing really well coming into the crisis. The retention ratio was about 45.4%. So their return equity 17.56, the retention ratio is 45%. If I assume that they maintain those numbers, and that's a big assumption, you know what the growth rate would be for the future? I don't even have to estimate it. It's going to be 45.37% times the return equity, which gives me a growth rate of close to 8% in earnings per share. Growth becomes an output. It's not an input variable. It's driven by how much you reinvest and how well you reinvest. That was June of 2008. Did I see a storm coming? No. As you know, in September of 2008, you had the crisis. And one of the things that came out of the crisis is banks were at the heart of that crisis. Remember, they were the culprits. So one of the things that regulatory capital authorities did right after the crisis is they raised the regulatory capital that banks need to maintain. Banks to operate have to maintain a certain amount of regulatory capital. Regulatory capital is just a fancy word for book equity. So banks have to maintain a certain book equity to survive. So let's assume it's September of 2008. Remember the calculations I showed you here? Let's assume the only thing that changed is now you got a Fed mandate that every bank raise its book equity by 30%. You've got to come in with fresh equity. Will that affect my growth rate? I mean, the growth rate I computed 3 months ago. Even if nothing happens to net income, if I need 30% more capital, what's going to happen to my return equity? Same net income, 30% more book equity, my return on equity is going to drop from 17.56% to maybe 14% because I have to have more equity invested. You put in a 14% return on equity into this equation, my growth will become less than 6%. Now do you see why when you value banks, you care so much about regulatory capital? Every rule that increases your regulatory capital will make your bank less valuable. There's no getting around it because by raising the regulatory capital, you effectively lower the return equity for all banks. You lower the return equity, you lower the growth rate, you lower the value per share. It's a very simplistic way of thinking about why do I care about regulatory capital? But you can see it play out. Last calculation and we'll be done for the day. So you can try that out if you want. So when you think about growth in earnings per share, you want to have a higher return on equity. That's the magic here. And you're saying, what's the big deal? There are two ways you can get a high return on equity. One is to go take really, really good projects. That's how Facebook and Google and Apple get high returns on equity. They take great projects. You know what the other way to get a high return on equity is? You take average projects and you pump them up by using debt. You know what I mean by pump up? When you borrow money and it costs you only 5% to borrow money and you can make 15% on a project, that difference goes to equity investors. Real estate developers through history have played this game to pump up their return equity. In fact, mathematically, you could write the return equity as an equation. You start with the return on capital. So that's what your return equity would be with no debt. And whenever you borrow money, you compute how much you borrow with the debt to equity ratio. That measures how much debt you're using and the benefits of borrowing, which is captured by the difference between what you make on your projects and what it costs you to borrow money. You can be a very average return company with a very high return equity with enough debt. And I'll use two examples to end today. I first went to Brazil, I think in 1997. And one of the first Brazilian companies I valued was a company called Brahma. It's now called Ambev. Brahma is the beer they make. And I remember looking at Brahma and then this huge return equity, 31%. I said, how the heck did they pull this off? So I took a closer look, and here's what Brahma looked like in 1998. Their return on capital was pretty high. So already you're starting with a high number, 19.9%. But remember, if they'd been all equity funded, that would have been the return equity. But here's what added to the return equity. For every dollar of equity they had 77 cents in debt. So that's the 77% debt to equity ratio. And they were borrowing money at an after-tax rate of 5.6%. So every dollar you borrow costs you 5.6%. You're making 19.91% on that. That difference of 14.3% is pushing up your return equity. I don't know about your company, but one of the things you might want to look at in your company is its return equity. And if you have a really high return equity, then ask a follow-up question. Is it because they're taking great projects, or is it because they're pumping up their returns using debt? You're saying, why should I care? Which would you rather have? If you want a company to be a valuable company, do you want them to take great projects, or do you want them to take average projects and pump up debt? It's an easy one. Andres?
Great projects, but
and where in your valuation, I agree with you, but where in your valuation are you going to show that? Because they're going to have the same return equity, same growth rate. So how are you going to penalize the company that has more debt? Where in your valuation will that show up?
I mean, like you said, in the return on equity, you could.
The return equity is going to be much higher for both companies, right? They both have 50% returns on equity. One got there using debt, the other got there by taking great projects. When I use return on equity, what's the discount rate I use to discount the cash flows? These are equity cash flows. The discount rate is the cost of equity, and the cost of equity is driven by the beta. And as you borrow more money, so what will be different is the second company that got a 50% return equity by using a lot of debt will have a high cost of equity. A much higher, the value effect is going to show up through the cost of equities. And that's one reason why I kept emphasizing levering betas and taking care of the debt ratio. But you had something to say.
Yeah, but couldn't you say that with that extra debt, you could potentially turn that average project into something great?
All you've done is turned into something great for the equity investors, right? If you buy a building's returns are set by the business you're in. You can't make a building magically deliver 30% returns. Real estate delivers 7 or 8% returns because of the way it's priced. So you can make your return on equity look really good, but it's an average business. Not a bad business, it's an average business. But debt can't make the underlying business a better business than it is, because debt is just something you added on top of it. It doesn't change the business dynamics. Tim, now you want to ask a question?
Yeah, I'll ask questions when the class is over, because it's not to our class.
Okay, good. Nick?
Yeah. It wasn't more a question but a comment. Like, it's about Amazon. Like, that's how they achieved this extraordinary growth, was by
wait. Did Amazon get the amazing growth with debt, or did they do it by taking great projects?
No, that's what I'm saying. Like, they invested in great projects. Like, they have a consumer-centric business model.
There's a reason the FANGAM stocks are the FANGAM stocks, right? The FANGAM stocks have $1 trillion value. You don't get there by accident. You don't get there by taking average projects and pumping up the returns with debt. There's a reason International Harvester is not a $2 trillion company. It's not a bad company. It's in a decent business, but it's never going to earn 50% returns on its investment. So whether you look at Facebook or Microsoft or Apple, a common feature you will see is they make 30, 35, 40% returns without even touching debt. They don't need debt, right? One final page and then we'll end for the day. I grew up in India and I left India about 42 years ago, so it's been a long time. But I go back to visit my parents and somehow people seem to find out that I'm coming. And I have a whole list of invitations the day I land where my mom will land and said, this company would like you to, and I said, look, I didn't come here to talk to companies, but many of these companies are run by people that I know, that I knew when I was a little kid. I can't say no to them. So I remember about 20 years ago, I was back in India and my mom handed me this company called Titan Watch, it's a well-known Indian company. And she said, they would like you to come and talk to their board because they have an issue. And so I called the person who ran the company, the managing director. And I said, what do you want me to come in and talk about? He said, no, we're facing a problem at Titan Watches. We're doing what the textbooks say. And I said, what exactly do the textbooks say you should do? And he said, the textbooks say we should borrow money to increase our return on equity. And we keep trying it, but our return on equity keeps going down. I said, okay, let me take a look at the numbers. I'll lead you through the numbers and you tell me why it's not working for them. Titan Watches, when I looked at them, had a return on capital of about 9.5%. Not bad, right? Their debt to equity ratio was 191%. So he wasn't kidding when he said, we've been pumping up debt. They've been pumping up debt. But the after-tax cost of debt they were paying, and this was 20 years ago in India, in rupee terms, was 10.125%. You see what the problem is, right? They're borrowing money at 10.1%. They're taking projects at 9.5%. They're wondering why debt is not working for them. This is what happens when you don't look under the surface, when you take rules of thumb and just apply them. All you need to do is look at those numbers. The more I borrow, so the notion that debt pushes up your return equity is not magical. It's built on the presumption you can earn more than your after-tax cost of debt. Tony?
Yeah, Professor, just can you explain again what's the downside of like a high return on equity or like?
There's no downside to the high return equity. The downside is those returns on equity feed into cash flows to equity. The cash flows to equity get discounted back at a cost of equity. The cost of equity is driven by your beta. And guess what happens to your cost of equity as you borrow more money?
It goes up.
Why does it go up? I mean, after you just came off the first quiz, what's the mechanism that we use to show it go up? What's the cost of equity? Risk-free rate plus beta times
equity risk
premium. And where do we get our betas? We start with the business you're in, and we look at what debt to equity ratio you have as a company. So if you use a lot of debt, guess what happens? Your beta explodes, your cost of equity goes up. So you have the same growth and the same return equity as the other company, but you have a much higher cost of equity. Which means your value for equity is going to be much lower. Okay. I'm going to stop there because I promised you I'd stop in an hour. I've kind of gone over already, so I'll stop there. But when we come back on Monday, we will continue our discussion of growth. I mean, we're getting to a point where you should be able to start valuing your company if you haven't valued it, because the pieces are coming into play. We talked about. So next week, we will finish growth and terminal value, and then you're completely ready to go. But might as well get the inputs in, so you got the spreadsheet ready. You can always go back and tweak it. So this is kind of since the first quiz is just over, you have at least a little window where you can work on the project. So get your DCF started. I think the biggest thing is getting started. You keep putting it off, it's going to look bigger and bigger because you haven't even looked at it. So get the process started, and we'll talk about it next week. Tony, had another question? Or your hand up from before?
Oh, this question is about the quiz.
No, let's hold off on that note. But let me answer Tim first because he has a few questions and I'll answer.
Yeah, so my question is regarding the reinvestment rate and LBO. I've read a paper that you wrote, I don't know from when, but the value of control, the reinvestment rate, like how are they related? Like if I am planning to sell, like exit after 2 years, like does that mean the high reinvestment rate is just simply bad for the PE perspective.
So where did the LBO part come into the reinvestment trade? We can talk about the value control. The value control basically means you think you can run a company better than the existing manager. So I'll tell you a case where you can use the reinvestment rate as a lever to drive the value of control. Let's suppose you have a company that has great growth opportunities, but it's run by very conservative management. They don't reinvest very much money at all.
Yeah,
you know, like the value control can come from, right? So basically what you do is you take the existing reinvestment to say, if I ran the company, we'd be reinvesting 50%, not 15%. When you reinvest 50%, your growth is going to be higher. And assuming the projects you're taking are great as well, you're going to get a much higher value for your company. No LBO is ever done. No LBO is ever going to be done in a company like that, because in an LBO, you borrow a ton of money. Who's got the money to reinvest? So you know what kinds of companies are focused on in LBOs? You have a company that's reinvesting too much.
Oh,
what is too much? You're reinvesting 80% and earning a terrible return on capital. You're opening stores and nobody's coming into your stores. Coles, right? Being targeted right now. You know what the activist investors at Coles want them to do? Stop opening stores.
No.
Okay? They want the reinvestment rate to be pushed down, which means you reinvest less. Your growth will drop as well, but they say, look, it wasn't good growth to begin with. When you reinvest less, you have more cash flows left over. And guess what you use the cash flows for? As a leverage buyout, what's your first and biggest priority? What do you need to do right after the LBO? You need to pay down the debt. So what they do is they take these companies, reduce the reinvestment, take the cash that have been reinvested in stores and put it to pay down the debt and make the company smaller over time. And presumably in 2 years, you sell the slimmed down version of a company to somebody else saying, look, this is Kohl's with 1/3 of the stores, but these stores are all in the best locations. They make much higher returns. So what you're doing in an LBO is you're targeting companies that are reinvesting too much in businesses which have turned bad. You make them smaller companies and use the cash to pay down the debt. And then you flip it to somebody else as a slimmer version of the company. That's at least in theory, that's what you're trying to do.
So my go-to suggestion for a company that has too much of reinvestment rate is to slim down, just decrease
become
amount.
Smaller. Yeah.
Okay. All right.
And that's what a lower reinvestment rate is no. It could even be a negative. Yeah, it could even be a negative reinvestment rate, which means you're shutting down stores you already have, taking cash out of the business.
So if I do that, doesn't that kind of overlap with the restructuring part? Like it's related to
restructuring is just a word. What does restructuring mean? You're changing the way you invest. You're changing the way you finance. So restructuring is just a word that covers all of those actions. So when somebody says I'm restructuring, they've got to tell me on which dimension. This is a restructuring of your investment asset side. You can try to restructure your financing side, and you can even restructure how you return cash. So restructuring is just a generic word that covers all of those aspects.
I see. Thank you, Professor.
Okay, folks, I am going to stop sharing here. Okay.
Professor.
Tony, what was your question?
Right, so Professor, I just took a quiz and then I can already like see the grade on OM classes. So I'm wondering, like, is that grade like complete or
based on whatever you turned in? So whatever. So it's out of 10. So make sure you're not taking it out of 100. So is it already showing up?
Yeah, already.
On the grade book?
Yeah, on grade book.
It is the grade that you got based upon what you turned in. Are you able to see the answers to the questions yet?
No, I can't see like where.
Okay, then by midnight you should be able to see those. So you should be able to see what the reason you got the grade was.
Okay.
Yeah.
Thank you.
You're welcome. Take care.
Thank you. I had a question regarding the equity risk premium part of the project. So I watched the webcast where you go over it, and I pulled up the spreadsheet and everything, and I was just a little confused with the trailing 12-month part, because I know you said that comes from the S&P 500 reporting, I believe.
Yeah.
But the way you got it, or the way like it's computed on the spreadsheet, the numbers found. I'm trying to pull it up before I.
It's in billions. You got to convert into index units, because the index is not a market cap. So basically, let's suppose you have a market cap of 10 billion, but the index is stated in units of 500. So the index says 500 and matches up to a market cap of 10 billion. I have to take the earnings and dividends for the entire index, which are in actual dollar terms, and convert them into index units. So what S&P reports is how much the companies paid out in billions of dollars in dividends and buybacks. It's like 900 and something billion, I think, is the actual number. And then convert the 900 billion into equivalent units in terms of the index, because I'm doing everything in index units.
Okay.
So if you look at how I got the trailing 12 month, it should be the last 12 months of dividends, buybacks, and earnings converted into index units. It'll be multiplied by like that 0.111 something. That's actually the conversion factor to get into index units.
Oh, the unit adjuster, is that?
Yeah. So here's the unit adjuster, right? If I asked you what the Dow is at, you said 30,000. If I asked you what's the market cap of the Dow, let's say it's 30 billion. Or let's say it's 60 billion. That 60 billion becomes 30,000. So when the index goes up 10%, you're actually going from 60 billion to 66 billion. So all you're doing when you're doing an index is you're scaling a number, because indices could be stated as billions, but the problem is it's huge and people don't relate to it. So they convert into units that you're more, so S&P of 3,800 and something, which is where we're at now, translates into a market cap of like $26 trillion. Because that's what the actual market cap of the 500 companies is. So what I'm doing is I'm taking the S&P 500 and the market cap and saying, if this is the market cap that gives me the index today, then how do I convert the earnings and the buybacks into units that are also in S&P 500 units? Because I can't just use the dollar values with the S&P 500. It's in the wrong units. So that's what the unit adjuster is. It's a way of converting what's in billions of dollars into units that are comparable to what my S&P 500 is.
Got it. Okay. Thank you.
Okay.
Hi, Professor. Can I ask a question? There's this company I follow in Brazil that is a shoe retailer, but they don't own the factories nor the stores because they franchise. And they have been growing through like franchise openings, and they don't have to reinvest a lot because the franchisee does their investment.
Right.
So how do you think about this in terms of growth?
It's a low capital intensity business. The plus is it's a low capital, and it's lower margin business as well, because you're getting a slice of the franchisee's profits.
True.
So it's not better, it's not worse. Like McDonald's versus Starbucks. McDonald's is a franchise business.
But there are
Starbucks is
30%. It's very high.
Because it's low capital intensity. I'm not surprised that they have a high ROIC. The question is, no, you can have a high ROIC, but in a very small capital base, the overall growth you're getting can actually be lower than if you. So if I ask you, would you rather have a 15% ROIC or a 30% ROIC? The answer is simple. I'd rather take a 30% ROIC. If I asked you, would you rather have a 30% ROIC on $1 billion capital or a 15% ROIC on $100 billion capital?
Yeah.
It gets to be a trickier question. Franchise businesses are low capital intensity. They often have better returns on capital as a consequence, but it also means that the overall company could still be worth less than an otherwise similar company that chose to open its new stores. Otherwise, everybody would franchise everything.
Got it. Yeah. Thank you.
Andreas, your question?
Yeah, I have a quick question, if you don't mind. It's more of a general question. So recently, like we've been seeing a lot of the companies which are just ideas that have entered into the stock market, but like I'm referencing back to one of the first lectures where you said you can't really value anything that doesn't have cash flows, or
No, I said you can't value anything where you're not willing to estimate cash flows. An idea, so you don't have to have cash flows in the past. You just have to be able to estimate cash flows. An idea business is still a cash flow business. The difference is you have to estimate the future cash flows without the crutch of having past financials.
So do you think it's still potentially like hard to do it for the project, but like in general, or?
It is hard unless you understand the idea really well. If you think about it, with value and idea business, you got to get a sense of what product comes out of the idea. Ideas don't make revenue. So you got to go through the process of converting the idea to a product, the product into a business model, the business model. That's what every founder of a startup does, right? So you almost have to behave like a startup founder and flesh it out, which means you've got to understand the idea well enough to know what the potential pathways to make money are.
But then wouldn't it be comparing it a lot to the industry, for example, and then that would end up in like price?
Because in a sense, you're looking at you're not comparing the industry, but you're drawing on industry-wide data. The total market has to come from looking outside. The margins have to be coming from. So rather than look at the company's history, you have to look more at industry averages. That doesn't make it more difficult, less difficult. It just means you look in a different place for your numbers. So as you know, the idea business is you got to be most cautious about it. The idea business, so we don't even know what the business model is or how it'll make revenues, because then you don't even know what kinds of businesses to look at to get us into what a typical margin is. So if it's that early in the process, I would steer away, because unless if you are the founder of an idea business, then it makes sense to actually think about how because then you can do the hard work because it pays off for you. But if you're not, then you're too much on the outside to be able to value something that young.
Okay, thank you.
Yeah. Yes, Rodrigo. Your question or are you done? Okay.
Thank you, Professor.
Bye, guys. I'll see you on Monday. Take care.
All right.